So we're waiting for the handover from Asia into the European trading day. The European day, then, really underscoring risk appetite today, attached to the French election, the outcome we know of just the first round. Do we think that this appetite for risk is sustained, or might it fade, I suppose, is one question, as we wait for further clarity on round two?
Well, yeah, and it's an incredibly complicated set of variables here as well, Anna. We still don't know what the second round of the French vote is ultimately going to look like. But Macron must be hoping that he's a little bit like George Russell in the weekend's Grand Prix. You know, the two parties way out in front, a little bit like the race between Verstappen there and Lando. Maybe they'll take each other out to a certain extent and allow a kind of third way through where the centre manages to hold enough of the balance of power in the French Parliament. Markets can muddle through that there isn't that extremist on one side or the other that is going to drive markets too far off track. And what we're seeing today is some of that risk premium that had been priced into markets for the more extreme scenarios coming back out again. And therefore, the higher euro, the tighter spread, and the rally in French equities in particular. But it's not going to take all of those gains back in one day. It's certainly going to be a slow process first to get through the rest of this election, and then to regain trust and rebuild trust, particularly in the bond market, which, when it has a knock like this, tends to take a little bit more time to regain confidence.
Paul, so uncertainty in France, but uncertainty in the United States as well. We're trying to figure out exactly what is going to happen. Is Joe Biden going to continue as the Democratic nominee? Is somebody else going to replace him? How do you price this? Has anybody figured out how to price this into market yet?
Well, I think that the strategists are starting to come out with their trade recommendations, at least, based on the premise that Trump scored a victory in the debate last week and is in the ascendancy now. So, for example, Morgan Stanley is out today saying Treasury yield curve steepness is the way to go. His immigration policies are likely to slow growth in the short term, which will allow the Fed to cut interest rates more, meaning lower short-term yields. But his policies on tariffs are likely to be inflationary, pushing up the back end of the yield curve and therefore giving that steepening. So that's the way that people are starting to think about it. What's the clever way to play this, assuming that Trump is looking pretty much like a certainty at this point.
Well, Paul, in that same vein, do you take duration risk right now?
Well, I mean, there's a lot of risks out there as well, aren't there? Particularly, I think there's that dislike because of those inflation risks that we're still seeing in the economy. And that's why the jobs numbers at the end of this week are going to be really important to pick up from what we had from the PCE last week, which showed that slowing. We'll be looking at the wage growth data as well as the headline number on jobs. If that continues to slow, it will allow the Fed to do that kind of more easy reduction of interest rates the way that it would want to do it, rather than having to slam on or having to hold out even longer. That's what we'll be watching for.